Welcome students to another video. We're going to be looking at investment management. We're focusing on equity asset valuation. This is support material 4. We're going to be continuing with another 2 study units. We've moved away from topic number 1. We're focusing now on topic 2, which is specifically looking at equity analysis. Please note that when we're focusing on equity analysis, we're looking at equity as a form of investment. Because we look at investment management, we look at assets we can consider that's going to generate a future return on investment. So if we're looking specifically at equity analysis, we're going to be looking at how do you value shares in order to make decisions on whether you should buy or sell a particular asset. We're going to be focusing on company valuation. So we're going to be looking at specific companies, and we're going to be focusing on how do you establish value? How do you calculate value when you're looking specifically at a company? So when we're looking at company valuation, always remember that time value of money principles are going to apply. When we spoke about time value of money, we said we're going to be using the dividend discount model. We're going to be taking future cash flows that occur in the future, and we're going to be discounting them back in time. If we can determine what the current value is of those future dividends, that's going to give us an estimate of value in today's terms. So just remember, when we're looking at any application, if we're looking specifically at future cash flows, they can be dividends, they can be interest, it doesn't matter. Earlier we spoke about how bonds can be valued. When looking specifically at equity, equity can also be valued. We just need some sort of expectation with regard to the future cash flows that a particular company will provide. So remember, when looking at time value of money, we're focusing on valuation. We're focusing on discounting future cash flows back in time. When we're focusing on present value, that present value that we're going to be calculating in terms of time value of money is representing the actual price of that particular asset. And when we're looking at dividends, and we're focusing on discounting those dividends, that's going to give us an expectation of the value of that particular asset. So just some tips when looking at these types of calculations. Earlier on, we spoke about the differences between nominal and effective rates. Please remember that a nominal rate is a quoted rate, and then you get an effective rate, which is taking compounding into consideration. Remember, in calculations, you're going to be inserting the actual effective rate. So if you've got quarterly payments or quarterly dividends, or you've got a number of quarters, remember everything needs to be in line with the interest rate. Okay, your payment and your interest rate, both of those two variables need to relate. So I and PMT are vital when doing time value of money calculations. When inserting your PV and your FV, as long as you've got the right cash flows in place, you can calculate either of them as long as you have enough variables to insert in the calculation. So just remember that N, your I, and your PMT, they all need to relate in terms of time frame. So if you've got quarters, then you're going to need the number of quarters, you're going to need a quarterly interest rate, and you're going to need the payments per quarter. So when we're looking specifically at time value of money calculations, always remember that those variables are going to guide you in terms of your calculation. You need to identify what those amounts are, and when you're substituting those amounts into your actual formula, you're going to be inserting the right variables to get to the right answer. Right, so if we had to relate time value of money to equity valuation, we know that there are 5 different variables to use in any calculation looking at time value of money. We've got N, which is the time frame or the period. If we're looking at equity valuation, your N is representing the investment horizon. In other words, how long are you going to hold those shares for? When looking at the I value, which is the return on equity, that's the rate that you're going to be looking at in that particular calculation. So if the focus is on valuing equity, we need some sort of return on equity, and that's representing the I in our calculation. The PMT is representing the payouts, which we're going to be receiving from the equity that we've invested in. So those shares should pay out dividends. If those dividends are paid out regularly, then we have a payment, and we're going to insert that as your PMT variable in the time value of money calculations. Then you've got FV, which is the future value, which is the end value. We know FV is the future value, so we would expect to sell our shares at a certain point in time, and we can estimate what the future value could potentially be, and what sort of return on investment we could get having invested in equity. And then the the PV, the last variable, is the price of the actual share. So when looking at time value of money, I can take future cash flows, I can discount those future cash flows back in time to get a representation of value in the current situation, in the present moment. So PV is what you would pay, or what you would expect to pay for a particular asset based on the current information that you have available. So how do we do these different calculations? Well, there are several different methods to look at. The first one that we are going to be covering here is the dividend discounting model. When looking at these simple time value of money calculations, we're going to be using this formula. Your PV at time 0, which is now, okay, remember we're trying to discount future cash flows back in time, is going to equal the dividend at time 1, so in the first period, divide that by the rate minus the growth. All right, so this is actually from the Gordon growth model. It's taking future cash flows and discounting them back in time. When you're thinking about equity asset valuation, what are the future cash flows going to be? Well, potential dividends. So whatever dividends I have in the future, I need to discount each and every one of those dividends back in time in order to get an estimate of the present value or the share price at that current moment in time. So when you're looking at PV, just remember that PV is at time 0 and you're discounting future dividends back in time. If there is a growth rate, so in other words, the dividends may be growing at a certain rate, certain companies would want to increase their dividend payouts to make their companies appear to be more valuable to the investor or the shareholder. So that depends on their dividend policy. Companies decide how much to pay out. So when we're looking at the dividend discount model, just remember this equation: PV0 equals div1 over R minus G. So what am I looking at here? Well, the future. There's something we need to consider when looking at dividends. Are those dividends going to stay the same, or are those dividends going to grow? Those dividends can be different amounts in the future, depending on the profitability of the company and how much they choose to pay out. So it's always important to note that when discounting future cash flows back in time, those future cash flows need to be as accurate as possible. Because if we don't predict or estimate those future cash flows accurately, there could be problems with the valuation. Because remember, the valuation is based on your expectation. Right? So it's just a guide. It's just a guide in terms of value today, in today's terms, and what you would expect to pay for that particular asset. Right, there are multiple stages in terms of these models that you can use. You get 2-stage, 3-stage, you could get a multi-stage dividend discounting model. Just remember, all you have to do is draw up a timeline. Right? If you have a 2-stage model, that refers to an unstable amount of initial dividends and then followed by some sort of constant or stable growth. So if I'm looking at more stages, if I have a 3-stage model, well then the expectation in terms of dividends will alter or fluctuate over a period of time. Because I'm taking future cash flows and I'm discounting those future cash flows back in time, I want to make sure that those dividends are reliable. In other words, have I estimated what those future dividends are? Maybe I might want to use a 3-stage model. Remember, model is an expectation. Okay, you're building some sort of equation that represents what could potentially happen in the future. So if I have a 3-stage model, I'm looking at an initial phase of stable growth that will last for a certain period of time. And then in the second phase, there could be growth that could decline until it reaches some sort of stable level where those dividends could remain the same as constant growth perhaps a certain percentage growth, or staying as is. It all depends. And then you can obviously draw a picture, plot all those dividends on the actual timeline, and then individually discount all of those dividends back in time. And you can use your calculator to do these calculations, because you're going to be working out the present value of all those future dividends. So just a tip, irrespective of which model you're going to be using, always remember to apply the basic time value of money discounting rules. The best advice I can give you here when approaching different test type questions is to highlight what the dividends are and discount those future dividends back in time. So let's have a look at some of these examples. Number one is giving you information here that an analyst expects. So following a related share, which is share X, they expect a cash dividend of 3 Rand in year 1, 2 Rand 50 in year 2, 3 Rand 50 in year 3. And then the analyst plans to sell the share at the end of the 3-year period for 85 Rand per share after collecting the third dividend. So remember, when we're looking at all of these amounts, we need to draw a timeline. We need to put those future cash flows on a timeline and then discount all of those future cash flows back in time to get your present value at time 0. There's some additional information given here. The company's required rate of return is 15%. Right, please remember, we've looked at the capital asset pricing model, CAPM. CAPM is an indication of the rate that is applicable when doing certain valuations. You've learnt about CAPM in financial management. CAPM also comes up here in investment management. So just remember that when looking at the required rate of return, that required rate of return would have been calculated taking risk into consideration in order to get some sort of measure of what is required as a return from a particular asset. So if we're looking specifically at time value of money calculations, always remember that we're focusing on present value. We're trying to determine what the value is based on those expectations. Right, so draw the timeline, take all of those future dividends and discount them back in time. Remember to always present value all those future cash flows back in time in order to get an estimate of the share price. Right, so what we're going to do, we're going to take each dividend and we're going to discount them back in time. So div 1 will obviously occur at time 1, so n is 1. Your future value is the dividend, and you're going to be calculating your present value, which is your estimated present value for that particular dividend discounted back in time at the required rate of return. Right, so I've done that for each and every one of those dividends. You can see dividend 2, which was the 2 Rand 50, you've discounted that back, so your future value, discounting it back to get the present value, is that 1.89. Then you've got dividend 3, which you're going to be discounting back in time to get the 2.3013. Right, I'm using 4 decimal places here just so that the final answer will be accurate to 2 decimal places. And then obviously at some point I'm going to sell those shares that I've bought, and if I sell one share at 85 Rand, I'm going to have to discount that back in time to get the current present value, which works out to 5588 8889 as 4 decimal places. So all I have to do now is literally sum up and add up all of those amounts to get an estimate of the actual share price that I would be prepared to pay for a particular asset. So now I know, based on those future expectations in terms of dividends and an estimated share price, I believe that this share is worth 62 Rand 69 if I round it off to the nearest 2 decimal places. So what I would do then is I would look at share X. I would go to the market, maybe the JSE for example, or whichever equity market that you're going to be looking at in terms of valuations. So if share X is valued at 62 Rand 69, if the current market price is less than 62 Rand 69, then I would consider that as being a buying opportunity, because I can buy those shares at a lower price than the current price that I expect in terms of value. I value this share at 62.69. If the current market price is more than that, then I would consider that asset to be overvalued. And if I held shares in this company X, then I might be inclined to sell those shares. So remember, we're going to be selling when shares are considered overvalued, and we're going to be buying when shares are considered undervalued. Right, the next example is looking at an analyst's expectation where you have share Y. You also have a cash dividend here of 4 Rand in the first year, 5 Rand in the second year, and 6 Rand in the third year. The analyst plans to then sell the share at the end of the 3-year period for 125 Rand per share after collecting the third dividend. Your job, again, is to use the required rate of return and determine or calculate the present value of the share. All right, let me just show the answer. If you do that calculation, right, taking all those future dividends back in time, maybe just to show you a little diagram quickly. Okay, I would insert all of those dividends on the actual diagram. So 4 Rand in year 1, 5 Rand in year 2, 6 Rand in year 3, and I'm also going to be selling the share at the end of year 3 for 125. Right, all of those cash flows need to be taken back in time. 2 times 0. And I need to work out the present value. Right, so you can use your calculator to do this. Right, you can treat each of these amounts as a cash flow, and you can discount those future cash flows back in time using your cash flow button or your cash flow function. All right, if you do that, then just make sure that you don't put any amount for time 0. Time 1 would be 4, time 2 will be 5, time 3 will be the 6 and the 125. Right, and then you need to insert a rate, which is 12%, and then you would calculate what the present value is. And you can do that using your net present value. Right, that's why I'm saying you can use a shortcut. You can use the cash flow function on your calculator. You can insert this as your first cash flow, that is your second cash flow, and that is your third cash flow. As long as I've given a 0 value, for the initial investment or initial amount, when I solve for NPV, it's going to give me the PV, the present value, right? And your answer should be 180 cents. Okay, so again, what have we calculated? We've calculated the price of this particular share based on the future expectations in terms of dividends. As long as I've discounted those future dividends back in time, I then have an expectation of value. I can say that this equity is worth 100 Rand and 80 cents per share. So again, if I go to the market and I see those shares are selling at less than 100 Rand, that would indicate that those shares are undervalued. So then I would purchase those shares. If the price in the market is greater than the 100 Rand and 80 cents, then I would consider that share to be overvalued. So it all depends in terms of your workings. Do you consider those particular companies or shares in those companies to be undervalued or overvalued? All right, so you've got the answer to that one. Let's look at a different calculation where you are going to be having to use the constant growth. So this is actually part of the Gordon growth model. So if I have a question where the analyst believes that there is going to be a first dividend that will be received in year 1 amounting to 5 Rand, you also expect the share to continue paying dividends into the future with a dividend growth rate of 5%. That's the giveaway. The G is representing the growth. Then you've got a required rate of return, which is 20%, and they want you to determine how much are you willing to pay now for this particular investment. Right, so present value, again, PV at time 0 would be the future dividends. Okay, div 1, remember it's div 1, so we have the future dividends discounted back in time, taking your rate and your growth into consideration. All right, just to show the answer here, right, there's the working. Okay, your 5 Rand dividend, which is in year 1, divide that by your rate and your growth. So I've converted those rates into decimals. Okay, percentages into decimals. So 0.2 minus 0.05. And if I determine what the present value is going to be, I'm going to get an amount of 33 Rand, 33 recurring. That's the expectation. Right, so again, we would have to determine how much are those shares currently selling for. If the JSE was selling those shares at a current price of 20 Rand, well then you would consider this equity to be undervalued because it's worth more based on your calculation. So then you would buy that undervalued equity. Let's do a few more examples. Right, please pause the video and have a look at these calculations and then come back and check your answer. Do the calculation using the right formula and see if you're on the right track. Right, so example number 4 is looking at an analyst believing that the first dividend to be received in year 1 is 11 Rand. You expect constant dividends to grow at a rate of 4% and you have a required return of 15%. How much are you willing to pay for this particular share? Right, so again, just to show the calculation, there's the answer. Right, your dividends divided by R minus G. Okay, don't forget the brackets. Okay, remember, you have a denominator which has a calculation. Okay, your rate minus your growth. Next example. Example number 5. An analyst believes that the first dividend to be received in year 1 is 6 Rand. And then you also have 8 Rand in year 2. Then it is expected that from year 3 onwards, dividends are expected to grow at a rate of 4% from the last year. Right, so your required rate of return is 18%. How much are you willing to pay for this investment? Right, let me draw the diagram. So you have something to interpret, analyze. All right, so year 1, 6, year 8, 2. Okay, and from year 3 onwards, the dividends are expected to grow at 4%. Okay, so this dividend is going to be calculated. Okay, we don't know what the dividend is, but we know that dividend is going to be increasing by 4%. Okay, so I need to times that by 1.04, which is increasing it by 4%. That's going to give me an amount, okay, a value for that dividend. Right, and this dividend is going to constantly grow at 4% afterwards. All right, so I can use the Gordon growth model for this part of the equation. All right, and remember, if this is the dividend at that point in time, okay, your P0, your present value, is going to be sitting here. That's the dividend you're going to be calculating, the present value of those future dividends. All right, so once you've calculated the PV, having used dividend 1, which is occurring here at this point, okay, dividing that by R minus G, that's going to give you an estimate of the present value of all of those future dividends from that point onwards. Right, then you've got that dividend, the 8 Rand dividend, and then you've got this one amount representing all the future cash flows. Those amounts you're going to be discounting back in time to time 0, and that's going to give you your share price, which is your estimated PV. Right, so just to give you an answer, once you've done the calculation, there's your answer. PV is 53 Rand and 51 cents. Right, we have 2 more examples here for you to have a look at. Okay, here we have dividends, a stream of dividends. Year 1, 5, year 2, 7, year 3, 8, year 4, 7, year 5, 6, year 6, 8. Okay, we expect to sell share Y at the end of year 6. So T0, T1, 2, 3, 4, 5, and 6. Okay, you expect to sell it for, other way around, 210. Okay, what am I going to do? Well, it doesn't matter how many dividends you have. Okay, this is like a few dividends that are repeating, well, not repeating, but taking place. Okay, discount all those future cash flows back in time. Both of those occur at the same point in time. Take that back and work out the present value. Right, so again, I would use cash flow. Okay, use your calculator. Okay, you can insert each of those amounts in to the calculator. Okay, as the cash flow. Just remember at T0, you need to have a 0. Okay, you have to insert 0. No cash flow at the beginning. Right, then you insert your rate at 16%. And if you're using the cash flow, you would actually work out your net present value. So long as your first cash flow is 0, okay, the answer that you get will represent the present value, right, if you're using the shortcuts to work it out. Okay, if you do the shortcuts and you calculate it correctly, the answer is going to come out as 110 Rand and 84 cents. Right, you have one more to try. Here's another example. Okay, year one's dividend is 3 Rand. Year two's dividend is 4, year three's is 5, year four's is 6, year five's is 7, and then from year 6 onwards, we expect to pay a constant dividend of 5 Rand yearly. Right, so 5 Rand forever. Okay, no growth. Right, so again, PV0 equals div 1 over R minus G. Okay, there is no growth here. So the present value that we calculate here, using the 5 Rand forever, over the rate, which is 15%, okay, minus no growth, so you don't have to show that if you don't want to, right, gives us an amount, okay, the present value. Right, please type that into your calculator, get an amount. That amount is sitting here. Okay, so you've got this amount, discount that back in time. You've got this amount, discount that back in time. This amount, discount that back in time, discount back in time, discount back in time. And that's going to give you a present value, all right, for all of those future dividends. Right, so if we look at the answer here, okay, I've shown workings here for that perpetuity. We spoke about it. The 5 divided by the 0.15. Okay, the 15%, all right, gives you a PV, the present value. Okay, and then you're going to solve for the present value at the beginning. Okay, and if you calculate that, your answer is 32 Rand and 44. Not 44, sorry, 32,40. Right, next study unit is looking at theory, okay, looking specifically at technical analysis. Remember, the focus is still looking at equity valuation. We're looking at companies. Right, so when we're looking at technical analysis, this is all theoretical, okay, theory. There aren't any workings or calculations in this particular study unit. When you're looking at technical analysis, we're looking at charts. We're looking at measuring trends. Right, so if we're looking at past performance, if I have information about the past that can help me forecast and potentially predict the future. So if I'm looking at these trends and I'm looking at these prices, in investment theory, there's something called the efficient market hypothesis. And that basically means that when you're looking specifically at any chart, any graphical representation of financial information, we would expect that the market has priced in all the available information in the market in that current asset share price. So when I'm looking at technical analysis is looking specifically at measuring prices in the market and trying to identify trends so we can make better investment decisions. When looking at technical analysis, there is a level of market timing because you're looking for trends, you're looking for changes in the technical analysis. You're looking for things that can either help you or guide you in terms of expectation. Okay, you're expecting something to potentially happen. Right, in the textbook, they talk about Dow theory and they talk about price patterns and cyclicity. When looking at price patterns, We know prices are going to be showing or pointing towards a certain expectation. Right? If prices are rising, we would expect an increase in value. Right? If prices are falling, we would expect a decrease in value. And then cyclicity talks about how prices rise and fall over a period of time. Right, so when you're looking at this chapter, just note that it's technical analysis. We're going to be focusing on these different orders that can be placed in the market. Right, so I have entries and exits. Entries where I'm going to be buying or selling, getting into the market. Exits is when I'm going to be getting out of the market. Right, so your job is to decide on when is the most advantageous point in order to buy a particular asset or to sell a particular asset. So if I'm looking at direction, which direction is the market going in a bull market and which direction is the market going in a bear market? Well, the bulls represent a market that's increasing, okay, so rising prices. The bear market is when prices are falling. Right, so we talk about long and short. If we're in a bull market, long means prices are expected to increase. Bear market, we're looking at going short, we're expecting prices to decrease. Right, so what does that look like in terms of technical analysis? Well, remember we spoke about examining past price movements to make an estimate on what the future may look like when looking specifically at these different trends. Right, so in a bull market, you're expecting these prices to increase over a period of time. So you've got higher highs and higher lows. If you're looking at a bear market, you're expecting those market prices to fall. So you will have lower highs and you'll have lower lows when looking at the actual trend. Right, so you have two separate opportunities. You've got long opportunities to buy when prices are increasing, and you've got short opportunities when you expect prices to fall. And those are either bear or bull markets, and we would be looking at buying or selling those shares that we have looked at in terms of technical analysis. Right, so there are many different trading strategies that you could potentially make use of that look specifically at technical analysis. There have been huge amounts of developments in the market in terms of trying to refine and make those models better when making investment decisions. Just remember that all of these things are looked at in isolation, right? Remember, it's just a guideline, it's a signal. It's something that can help guide you in terms of your own decision making. At the end of the day, it's still going to be your decision. You decide when you want to buy a particular asset or when you want to sell a particular asset. What is useful, though, is the power of knowledge and information and general analysis. It's very important that we analyze certain measures. And two of those measures are Fibonacci and the golden ratio. These are just levels, okay, when looking at prices and looking at the higher highs and higher lows, or the lower lows, lower highs and lower lows. So when we're looking at those trends, right, if markets are trending upwards, we would expect to buy. If markets are trending downwards, we would expect to sell. Right, so when we're looking at these indicators, just remember that there are multiple indicators that you can make use of. Others include MACD, which is the moving average convergence divergence indicator, and that indicator gives you an indication of whether a market is overbought or oversold. You also have other measures like RSI, the relative strength index. You also have a simple or an exponential moving average. And then you have other measures such as stochastic, which is taking mathematics and statistics and applying it in practice when looking specifically at prices. And we're trying to identify whether prices are increasing or decreasing. So just remember, when looking at technical analysis, you're trying to use those price movements, and you're trying to make decisions based on what you can see in the market in terms of potential trends. You either have a rising or falling trend, which represents a bull market or a bear market. Right, these are just some diagrams, okay, just highlighting these different trends. Right, when looking at Fibonacci is basically highlighting this like concept or this idea of a golden ratio. Right, so Fibonacci, a mathematician, obviously looking at different trends in nature, and this relates to even human beings as well. Right, humans, okay, are built or created a certain way. Okay, our arms and our legs are in a certain proportion to our bodies, and that's something that we need to consider. So, having looked at nature, Fibonacci looked at these principles, these ratios, right? 23.6%, 32.2, 50%, 61.8, and 100%. Those are different ratios that are used when looking at market analysis or technical analysis, where you're analyzing the market and you're seeing what could be happening in terms of those decreasing trends or increasing trends, depending on whether the market is rising or falling. So if you look at this diagram, you can clearly see that more recently you have a market that is declining, that's decreasing. And then you'll see at some point the market's going to start correcting itself. In other words, moving in the opposite direction because it's cyclical. Okay, there's cycles, market cycles in the market, right? And you can see here after that very, very long, okay, bear market, right? Prices are decreasing. At some point that changes and prices start to turn around, right? So Fibonacci just talks about how these are different levels of resistance, okay, or support, depending on whether you're going long or short, and that's going to highlight, right, where a potential level of support or resistance could come from when looking at a particular trend. Other indicators, merging all your knowledge of technical analysis, you can use various different indicators like MACD, the moving average convergence divergence indicator, and that can be a way to analyze whether amounts are overbought or oversold. Right, so just to highlight a few things, okay, you can see here, right, on the chart, right, you have higher highs and higher lows. Right, so you've got an upward trending market, and then at some point that changes, right? And then you've got lower highs and lower lows, and that continues to show itself over a period of time. Right, so just remember that when you're looking at moving average convergence and divergence, these are other indicators that you can add to the chart that shows you this convergence divergence. Right, so here at the top you've got an upward trending price pattern, and then here at the bottom you've got a divergence appearing. Okay, divergence meaning here you've got a lower high, okay, compared to that high, and here you've got a higher high compared to that high. So that's seen as divergence, okay, moving average convergence divergence. And sometimes investors can make use of these tools to make decisions on whether to buy or sell a particular asset. Right, then just some notes here, looking at technical analysis. There are trend lines and moving averages. You saw some of those on the previous slide. There are different candlestick patterns or open, high and low and close bars. Right, those bars are important to analyze what's happening in the market. Then you have levels of support and resistance, right, where prices can rise to a certain level and then have difficulty rising further. Sometimes prices will drop to a certain level and then have difficulty dropping further. And then you have different key concepts when looking at technical analysis. Sometimes there could be a breakout, okay, when prices fluctuate in a particular direction, either long or short. And then you can also implement different control measures to measure, or not measure, to manage your trading. There could be a stop loss or a profit target. So when you're looking at analysis, when you're looking specifically at technical analysis, your job is to understand what to look for, what to do, and when to do it. Okay, it's all based on past information. We're looking at the past to try help us predict the future. Just a few more diagrams. This is just to show what the Dow theory is. Right, you can clearly see that there's an upward trend here. Okay, we've got the market trending upwards, and then at some point, okay, we've got certain corrections. Okay, so when we're looking at Dow theory, we're looking at concepts where a bigger or a major trend, okay, is denoted by these minor or smaller corrections, okay, where you've got rising prices dropping, but overall you can see that the market is clearly sloping upwards. This is actually seen as a bull market. Right, then at some point you reach that level of resistance, okay, where prices have shot up, have gone up so much that at some point it becomes difficult to break through that level of resistance. Right, and then we're going to be highlighting that this could be a potential selling opportunity. Right, if we had to sell, okay, we would want to sell when prices are at their highest, and then assume or hope that these prices will decrease over a period of time. Remember, no one can predict the future. No one can make investment decisions that are perfect, but we can all analyze the charts and we can analyze the information that we're provided with in order to make the best possible decisions on whether to buy or sell a particular asset. So just remember, when looking at technical analysis, you're analyzing these price patterns in the market to make the best possible decisions. Right, you can also clearly see with this line, that's a level of support, okay, where prices have dropped, and they've dropped to a certain place, and then they start rising again. They drop, and then they start rising again. Sometimes those prices can drop further, right? Then you've got a breakout basically, okay, a break towards the long or a break towards the short, depending on which way the market is trending. Right, just some more graphs just to show you Dow theory. All right, here we've got a prevailing short or bear market, and then we've got these corrections, okay, where the market is trending in the other direction. But at some point, the market is going to go short or extend its losses. Okay, prices are continuously decreasing and decreasing and decreasing. Right, those small little price patterns could be identified as more in-depth analysis, looking specifically at different time frames. Because you could break down months into weeks, weeks into days, days into hours, hours into seconds, and we could look at these different price movements in the market. Right, just remember that these trends, right, give you an indication of what's happening in the market. And in this situation, you don't really have a trend here. It could be slightly towards the downside, but not very, very obvious. As long as you have an expectation of what's happening in the market, you can then apply your knowledge appropriately. Right, so there we've got a short trend. Okay, prices are decreasing. There we've got a short trend, prices are decreasing. Right, and that's in line with the trend, the expectation, what we think is going to happen in those situations. Right, and you've got lots of these that you can analyze. Right, and there's some more examples here looking at a monthly chart. Okay, so these bars are a lot bigger because those bars are representing amounts that would have taken place in the various months of the year and what the prices are going to be during those periods of time. And we could analyze that. We could look at those price patterns on a graph and make a decision on whether we should buy if those shares are undervalued or whether we should sell, depending on whether those shares are overvalued. So undervalued and overvalued is what we're going to be using here when determining whether we should buy or sell a particular asset. All right, just a few more arrows to show you upward trends, okay, and then obviously some sort of correction or decrease. Right, more charts to look at. There we go. We've got a short term trend. All right, we've got those smaller price patterns being analyzed, okay, and then we've got a note here, right, about different time frames. So what can you see in this chart? Well, it looks very choppy. Okay, there's huge swings up and down, up and down, up and down over a period of several months. Right, so this could be seen as more, what's the word? Not positive or negative, more neutral in terms of price patterns. There's no clear, definite trend in what's happening in the markets. All right, so let's consider some practical examples. Go have a look at some of the market prices for the different shares that you might be interested in. Okay, Google search those different diagrams and then make a decision. Consider what is happening. Just remember the price is the most important part because that's the amount that you actually pay. And price action is very, very, very reliable because we can see what's happening in terms of prices. And if we look at the prices, we can use statistics and we can expect or predict what could potentially happen in the future. All right, so just remember that price action is king. It is key. It's the most important measure. And then also just note that sometimes history does repeat itself in terms of investments, where you have certain opportunities that arise, buying or selling opportunities, and you wouldn't want to pass those by. Right, just to summarize, in this section we looked at company valuation and we focused on technical analysis. Please have a look at your study guide and your textbook for additional questions to practice.